Okay, Dave, thank you so much for taking the time today. It's been 3 years about since our last interview, and I really appreciate you doing this again.
Aaron, I want to thank you for your continued interest in Cogent and taking time out of your busy day to do this interview and give us a chance to explain some of the progress we've made in our Wave network and Wave product set, and maybe most importantly, how we differentiate ourselves with others in the market.
That's great. Well, I can't wait to get into it. And before we begin, I just want to remind viewers that this does nothing in this session constitutes investment advice. This is for informational purposes only. And we'll have some disclaimers that go up ahead of the video. So as we kind of rewind to 3 years ago, we talked about a lot about your background, how you got to kind of where you are with Cogent, but we spent a lot of time on the background. And in this session, I really like to zoom in on Cogent, especially relating to this acquisition of Sprint. Focus on the growth opportunities with wavelengths, some of the balance sheet and capital allocation decisions that you're making across the portfolio. And so we have a lot to get into, but where I thought we should start is talking about the business at a high level, the types of businesses you like to run, the ones that you want to keep in your portfolio versus the ones you don't want to keep in your portfolio. And uh, maybe we could just start there. What kind of businesses do you want Cogent to be in long term, and what have you tried to focus your efforts on?
Yeah, I think there are three attributes that are necessary for us to continue to focus on a particular line of business. First of all, that there is customer demand and that demand is growing, at least in unit terms. There is a continued industrial need for the products that we sell. Secondly, in the locations that we choose to sell those products, we have a superior value proposition for the customer. So therefore, if they are rational in their purchasing, they will purchase from us because we're delivering more value for a service that they need than any other provider. And third, when we sell those services, we have higher free cash flow contribution margins. So that means both EBITDA contribution and low capital intensity going forward. Telecom is an industry that is notorious for chasing growth and destroying value by investing capital with returns on capital that are typically below the cost of capital. Cogent has always focused on the growth segments in the market, and it's sought to have an unfair advantage, whether it be by acquiring distressed assets, by targeting only the highest traffic locations, by leveraging assets that others have deployed and then buying them at a deep discount, and then having a direct sales model where we could own the customer relationship and show the value that we are delivering. And then with that value, have high contribution margins from incremental sales. Telecom is normally characterized by selling a large portion of services that are either non-core or off-net. Both of those types of products have substantially lower contribution margins. And Cogent has been very focused since its inception on-net and core products. The acquisition of Sprint diverted us from that, but we were paid to take that diversion, and it was a necessary diversion in order to get control of the underlying assets that we have repurposed.
So when you talk about, of course, like if you give everyone a blank sheet of paper, of course you would all choose on net high margin services, low capital intensity, all of that. So, but that's not where the a lot of the industry ended up. Why do you think that was? What tempted people to go into the off-net products, the lower margin products, and what kept you from doing that?
Yeah. So most telecom companies are fighting the revenue attrition that comes with the migration of services from application specific networks to a dumb pipe or internet network. And that transition results in much lower revenue per bit mile. And in order to offset that, most service providers chase value added services, move up the application stack, and lose sight of their core competency, whether it's buying last mile from third parties without a compelling reason for the customer to buy from you, or adding value added services solely to chase revenue as opposed to profitability. If
Hmm.
capital was free, you would build a network to every endpoint and have every potential customer on the face of the earth as a customer. That is a fantasy. So you must be selective both around the locations you serve and the products you sell. And the products you sell, you want to accentuate products that leverage the value of your network. And the secret sauce in Cogent's core business was building an IP network that had the absolute lowest cost per interface routed bit mile, and it would take advantages of advances in technology more effective than any other IP network in the world. That allowed Cogent to dominate the market. We had over 200 global backbones, 1,700 regional providers we competed with, and we have emerged as the largest carrier of internet traffic globally. And in our on-net corporate footprint, we have 35% market share, being the highest entrant other than perhaps the legacy incumbent. In our transition to broaden our product sets to carry wavelengths, we realized that we needed to have a similar set of compelling value propositions. So the goal was to build a network that would go to the highest density locations. It would have the lowest cost per bit mile. Notice I left term routed out of it because that's not relevant. Because a wavelength is a deterministic product that has potential points of failure, you needed to make sure that your network architecture was sufficiently hardened to be more reliable, faster delivery, and lower cost than your competitors. You also have to understand that a wavelength product used to be a discount to a value added product such as internet services or switch voice. That world has changed, and today a wavelength on a per bit mile basis is actually substantially more expensive than the internet, but it has characteristics that customers value, whether it be the defined latency, which is critical for AI applications, whether it be the ability to transmit very large packet sizes, or the ability to be completely secure and isolated from the public internet. Any of those attributes may be the reason why a customer chooses to pay that premium. We had ignored that market by focusing exclusively on the IP market, And when the opportunity came along to acquire Sprint, we understood that we were taking bad with the potential for good. The bad was we were taking a non-core off-net business that was losing money, and we needed to do everything we could to fix the margins on that business, but we understood that it would be a perpetual drag on our growth based on the nature of the customers and the products that they were buying. But the upside was the ability to acquire a $20 billion capital investment for $1 and then repurpose that asset for a specific network architecture. Wavelengths are often used as a way to sell remnant or excess capacity. Wavelengths used to be referred to as private lines, and you would sell private line capacity after you satisfied your demand for all other services. Because that market is substantial and is growing, we realized that building a wave-only network would differentiate us from our competitors.
There's a couple follow-ups I want to ask about. So, when I think about Cogent, I think there are some analogies to a company like SpaceX, where, there's all the mythology around Elon and, using first principles to engineer a totally different cost structure to launch a kilogram into space. And that approach has yielded dramatically lower, orders of magnitude lower cost per kilogram to get into orbit. And I think that you guys, nonetheless, Boeing, Arianespace, other launch companies exist. They're just structurally inferior economically, and they can't really compete against what SpaceX can offer the market. I don't know if you think it's a good analogy or not, but I wanted to kind of bring that up and gut check how you feel about what you have built with Cogent architecturally, from an infrastructure perspective, from a network perspective, and from an organization perspective, because there's a lot of OpEx involved in selling as well. That can be there can be very big differences in efficiency there. But to the less informed investor or analyst that's watching this, if they say, well, Lumen can do waves, Zayo can do waves, so can AT&T, so can Verizon, so can Crown Castle, so can Aurelion, and so can Cogent. How do I know the difference between any of these? And why should Cogent deserve 25% market share? Talk about some of these structural differences that you've mentioned up to now, and what those look like, how they manifest. You talk about getting the most out of these technology curves. Why is that true? Um, so please give us some more details there.
Yeah, so there's actually three questions in your question, Aaron, and let
It
me
was a long
try to
question.
just
I apologize.
aggregate those. So, first of all, at the network layer, if we built a more efficient network, others could copy that architecture, and that barrier to entry would not be a sustainable moat. What we did is built a network architecture that not only is more efficient today, but is capturing the advances in technology more effectively than our competitors. So, a little different than your SpaceX analogy, where the rate of price performance improvement for the subsystems is not nearly as profound as it is for a transport network. We built a network that not only is cheaper today, but each time there is an advance in wave division multiplexing or optically interfaced ROADMs or any of the equipment necessary to deliver a wavelength, we can get more out of that advancement than our competitors. So
Is
in
it easy to explain why or how without getting really technical, such that you would lose me and everyone else?
so in building an IP network, the router performs four functions and actually makes this issue moot. It actually performs the function of routing, multiplexing, and 3R regeneration and DAXing or packing the circuits effectively. So as a result, the internet has replaced virtually every other network because it is both application agnostic and it is more efficient than any other network. In building a wavelength network, you don't have that advantage. You have to have a topology that allows you to extract the efficiencies. The router won't do that for you. And there are two competing design objectives. The first is to use your inner city spectrum or amount of bandwidth in each strand of fiber as effectively as possible. The second is to maximize the number of high traffic locations where you can sell service. Those two design parameters are actually at odds with one another. And the architecture that we have deployed, starting from scratch, allowed us to take a dormant voice network and optimize in both of those dimensions, allowing us to serve 1,100 data centers, to have transcontinental transmission without any intermediate regeneration, and to do that in a seamless way that allows us to maximize the throughput on the long haul fiber. It
But
was
Dave, sorry to interrupt you, but you said something just a few minutes ago saying if it was just an architectural decision, your competitors could copy you and it wouldn't be a sustainable moat. What you're describing sounds like an architectural difference that others could theoretically copy. Is that accurate, or how do you reconcile those two things that you're talking about?
So the same is true of Cogent's IP architecture as it is in its wave architecture. It is copyable, but to do that, you have to build a different business model and a different network from scratch. And those companies who we compete with are addicted to the higher revenue per bit legacy services, a classic example of an innovator's dilemma, and are unwilling or unable to build a network to compete. So when I first wrote the original Cogent business plan, my biggest fear was anybody could read it and replicate Cogent. And the answer is you could read it, but you would have had to be willing to walk away from all of your other revenue sources to focus only on the internet. Now, with the wavelength model, anyone could replicate this network, but you would have to abandon your existing network and existing product set.
Is that true, or could you
Second
just
thing,
segregate, could you isolate 10 strands of fiber or 20 or 100, whatever, 50 strands of fiber in your existing network that have no traffic on them and then do replicate Cogent's architecture?
you could do that, but you would have to get scale quickly. You would have to get the breadth of data centers that we connect to,
Mm,
and you would have to have a revenue acquisition model that works. So let's answer the other two parts of your question.
mm.
The first point is, where is that total addressable market? We have chosen 1,100 carrier neutral data centers where we can provision any to any within 30 days at any of three line speeds. That is 10, 100, and 400 gig. That means we have over 10 to the 2,800th power number of permutations. And our architecture allows us to seamlessly do that. The legacy architectures do not. And in fact, we have 3 times as many endpoints to sell wavelengths seamlessly in than our competitors. So we have both a addressable market advantage and an architectural advantage. The third point I would make is the way in which we acquire revenue. What investors often get enamored with is either technology or regulation in telecom, and they ignore the largest single cost of any telecom service provider, which is the subscriber acquisition cost or cost of getting revenue. The reason why T-Mobile became the most valuable mobile operator is they had a much lower cost of revenue acquisition than Verizon and AT&T, and they use that to gain market share and build a moat that is hard for the competitors to breach. In the case of Cogent, we are 100% direct sales. We have a sales force of about 600 individuals that sit in 51 locations around the world, configured in 83 teams. They only sell Cogent, they don't resell other services, and they are comped on net services that we add value to. That is very different. Every other telecom service provider has downsized their sales organizations and bifurcated their revenue acquisition into 2 models. A mass markets model that uses advertising and storefronts to get the very low end of the market as walk-in business, and then agents or third parties to sell value add along with their services, and they've gutted their direct sales model. So Cogent has a cost of revenue acquisition that is about 1/6 of the industry average. That comes from the value that we deliver. So for every customer, you have to put yourselves in their shoes and you have to ask 3 basic questions. Do they need what you're selling? Why will they buy from you versus someone else? And if they buy from you, can you make money at those price points? Cogent defines its products and its addressable markets under those 3 dimensions. That
Mhm.
is radically different than a company that's a roll up of 20 or 30 or 50 companies that have never been coherently integrated that sell every service to every potential customer, and each delivery is a custom one off.
Well, let me ask a follow-up on this because it's a very interesting topic, the sales model. And the pushback that I hear about when it comes from other investors about Cogent, um, sometimes revolves around this topic, which is that Cogent is 100% direct sales. You have a narrow product set. And if you're going against a 25-year veteran at Lumen that's got a whole portfolio of things that they can sell, forget profitability and discipline, but they can sell them and they can offer them and they can take them to the Super Bowl. Things that Cogent's not going to do, right? Because of the discipline you've instilled in the organization. Do you get, what I've heard is that people are concerned that Cogent doesn't get invited into the really strategic conversations. They may get the one-offs here and there where there's a real specific need and Cogent's network can address that. But they may not get invited in the room where Lumen is trying to, do 12 different SKUs on big nationwide contracts, including dark fiber and waves and IP and whatever. How do you respond to that concern?
So let's first of all look at our success in the internet market, where we are the largest. A decade ago, Lumen was the largest in that market. I actually had the opportunity to review their Investor Day deck, and it was particularly interesting. In 54 pages, they never mentioned the word internet.
Hmm.
And for a telecom services company to not talk about the internet to me, I find very strange. Uh, we focus on the fastest growing product segment and the highest traffic locations with the largest value to the customer. Customers who look to bundle are really looking for cross discounting. If you look at our revenue trajectory versus Lumen, you picked them, not me, as a straw man to focus on.
Mhm.
We have seen a organic 18-year growth rate till acquiring Sprint. We've seen 9 quarters of negative growth, but actually the Cogent business has grown throughout those 9 quarters as we attrited revenue that we wanted to intentionally decline, and we've seen our margins expand. Lumen has negative operating margin, meaning their EBITDA is declining faster than their revenue. And it's a little bit like in the food industry. McDonald's has a grill. It can cook a fine steak, but it does not compete with Morton's for steaks. It knows
Sure,
what it can do well and what it can't do well. And more people buy hamburgers than buy fine steak meals. And
sure.
they say, we'll ignore that market. Cogent is ignoring low margin and declining businesses, focusing on the only segments in telecom that have organic growth. And we have seen a great deal of customer receptivity to this narrow focus strategy. The final point I would make is on cross selling. Customers are sophisticated for these products. They are not going to be tricked by you selling them a voice service or a managed router service and say, okay, because I bought this service, I'll pay more for my wavelength or my internet service. They are really looking for best of breed. The analogy I would use there is like the home entertainment industry. When I was a little kid, they had these things called home entertainment centers, and they had record players and 8-track players
Mhm.
and TVs all built into this one God console that
Mhm.
you put in your living room, and nobody buys that anymore. Everybody wants the biggest flat screen monitor. They want to use their computer to actually stream, and then they buy their own sound system to broadcast that throughout the home. Each of those components of the entertainment experience are divided into best of breed.
Mhm.
I can assure you, a company like Google or Amazon or Microsoft or Netflix is sufficiently sophisticated that they're not going to be tricked into buying a suboptimal internet connection or a suboptimal wavelength because you're bundling in a managed service. Now, for
Sure.
corporate users, they also have been experiencing this phenomena of delamination of the application from the network. And I think Cogent's tagline is what people associate us with. Smart people buy dumb pipes. If you talk to any of our competitors, they will spend the majority of their time talking to you as a potential customer on why they're not a dumb pipe company.
Yeah,
And what they're
yeah.
really saying is, I can't make money on the network, so I got to figure out what else I can overcharge you on to cross-subsidize my network, whereas Cogent is very transparent about what it does. We will give you the very best value in network, and then what you do with that network is up to you and your business model.
Yeah, great. Um, Going to the, you talked about the revenue trajectory, the 9 quarters of decline, and I know that's turning around now. And we began the conversation talking about the businesses you want to be in versus the ones you don't want to be in. And I think this is kind of an interesting segue to talk about the Sprint deal overall from a very high level, like how you think it's gone. But it seems pretty clear that you have punted that bad revenue, the stuff you don't want to keep, as quickly as possible. It actually probably benefits the business longer term to have less of a headwind or less of a drag on it, even if it's made the financial results over the last 9 quarters pretty messy to interpret. But overall, big picture, how's the integration gone? What's gone according to plan? What hasn't? What do you think of it in terms of a you made the decision in, I think, September of 2022. You probably had a view of like what kind of value this deal could create for Cogent. Update us on where you stand on that from that perspective now.
Yeah, so we announced the deal in September of 22. We closed in May of 23. If we could have waved a magic wand and every dollar of Sprint revenue disappeared the day of closing, we would have been net ahead by $700 million because T-Mobile agreed to pay us $700 million to run that business over time, supporting those customers and managing that attrition. We have a very disciplined approach around locations, around products, and around customers that had us in 9 quarters reduce the acquired revenue by 64%. If we just looked at it on a pure dollars in versus dollars out, we're about $85 million ahead. We've received approximately 500 million of the 700, and we've spent about 400 and change of the 500 we spent. We have gotten that business to EBITDA break even. It is still a drag. It is still declining, and its margins are much lower than the remainder of Cogent. In that 9 quarter period, we have been able to increase our underlying EBITDA margins from 1% to 22%, nearly 1,000 basis points a year of margin expansion, but still we're at half of the margin that Cogent was before we did the acquisition. A third of our revenues are still coming from those low margin and declining revenue streams. We are contractually obligated to run those off, and we will maintain some over time with a lower growth rate and a lower margin profile. The Sprint acquisition was 2 concurrent acquisitions. The second was taking over the completely dormant Sprint network for $1. That was a foul asset that was burning an additional $140 million in carry costs, and it had no revenue, and it was obsolete because it was built to carry long distance voice. We then had a concerted program over 2 years to connect that network to our metro network, to reconfigure our network, to depopulate the buildings of old telephone equipment, repurposed 125 of the 482 buildings into data centers, and then optimized that network for a brand new business, selling wavelengths. That is not what Sprint did. That is not what Cogent did before. I would do this again for the option of being able to enter this new market and grow the TAM that Cogent has. And we think the network that we have built for wavelengths will give us sufficient competitive advantage that we will capture a quarter of that TAM, similar to the market share that we've captured in our IP network. So we got a free option funded by T-Mobile. Now, I want to say what went wrong. One, I think the revenue runoff was even more extreme than we expected.
Mm.
Two, the wavelength reconfiguration of the network was on schedule, but the customer uptake on services was behind. We had hoped to be able to generate waves out of a much smaller footprint and realized that we needed the whole footprint. We also needed to spend incremental unplanned capital on the data center conversion. That was a change in strategy as a result of the growth in demand for data centers and our belief that we could extract value that we did not anticipate initially by reconfiguring those facilities as data centers and then selling those facilities off. Uh, I think on the positive side, we got a tailwind from AI that we were not anticipating. On the negative side, there are acute shortages of space and power in data centers that is making it harder for customers to accept wavelengths in a timely manner. And we have not been able to change customer expectations as quickly as we had hoped. In the IP business, we were able to modify customers' expectations of what was expected, and we have brought down provisioning windows from 90 days to 9. We are the fastest provisioner of IP globally in 58 countries and 1,900 data centers around the world. For 11 years running, we have been ranked by independent third parties as the fastest to provision IP services. Now, for wavelengths, in our first year of service, out of 11 providers benchmarked, we came in number 2. There was one provider who was slightly better than us. And I think over the next several years, not only will we be the fastest, we'll be the most ubiquitous, and our lead will be substantial. Customers will become accustomed to the quality, the diversity, the reliability of what we have. I think the bear thesis had been that the Sprint network could not be repurposed for wavelengths effectively. We have today hundreds of customers and over 500 locations that are actually using our wavelengths and will attest to the fact that we're equal or better in quality, lower in price, and higher in reliability. As long as we can continue those measures of competitive advantage, our market share will follow.
There's a lot to cover from what you just said, but I want to go back to what you said about the the price of the deal, basically, which is that you would you would gladly take on $140 million of burn from this network to have an option at growing a wavelength business. You knowing what you know, everything you know now, because from the outside looking in, you've missed every target that you've given along the way on your relating to wavelengths. You still have the mid 2028 $500 million number out there that you're not changing. But I think almost I don't think anyone expects that from you, given the track record so far. But in order to make this a business that would interest you, to the earlier part of the conversation, you have to believe that you would make good money on the $140 million of burn that you've taken on, not just break even on it, right? You need to believe that you're going to have multiples of that in revenues to make this worthwhile. So what gives you that confidence? I think it relates to what you just said, better quality, lower price, higher reliability. These attributes are the things that customers will react to long term and gravitate towards longer term. But it's been a frustratingly slow start, even though those things are true. So, what gives you that confidence that this additional burn you've taken on and levered the balance sheet with, and all of that is kind of the prize at the end of that is totally worthwhile to you, and not just the option, but you see evidence that option value is converting into real value.
So this is a brand new business. It did not exist at Sprint. It did not exist in Cogent. Normally, new businesses are done in a private arena and they're funded with private equity or venture capital. We chose to be public to continue to operate our core business, and we are being funded through the excess payments from T-Mobile. So we were effectively not diluting our shareholders to give them a new stream of revenue and a new growth engine for the combined company with high contribution margins. The Wavelength revenues carry more than 90% EBITDA contribution with de minimis incremental CapEx. What gives us confidence is the total size of the addressable market, the frustration that customers have with their current legacy providers, and then three, are competitive advantages. And those competitive advantages are different for each potential customer. It could be route diversity, it could be reliability, it could be as one dimensional as price, it could be as simple as having the correct endpoints. You win business one order at a time. I'll go back to my McDonald's analogy. McDonald's is the largest food purveyor because it sells one hamburger at a time and it delivers more value than others. You're in Southern California. I'd much prefer to eat In-N-Out burgers than I would McDonald's burgers, but yet McDonald's revenues are orders of magnitude greater than In-N-Out
Sure.
because of their ubiquity and their scalability of their model and the addressable market that they focus on, which is a lower end customer. It is perfectly okay to build a business that is a commodity business focused on the best value in the market. That's what gives us confidence. There is plenty of demand. In fact, the demand is growing. When we initially expected to enter the market, we thought demand would be flat. We've been able to benefit from that growing demand and be able to leverage the strengths that I've just described and capture share. Now, the pace at which we're doing that is not as fast as we'd like, but it is a new business. It is very hard to give predictable, consistent growth parameters. We grew our Wavelength business 100% year over year last quarter and 19% on a sequential basis. Albeit from a small base, those are phenomenal numbers.
Sure.
But we need to have a bigger base to extrapolate from. There are a number of exogenous forces, whether it be the customer's ability to get equipment or space and power, but the demand is there. What is giving us the confidence in this market is the aggregate size of the market, the growth, and the fact that we have a better solution. This is a commodity business. I'm not winning business because of logo or branding or marketing. And I think that customers will be as rational for wavelengths as they have been for IP services.
Are you seeing behaviorally, in terms of cohort performance of like earlier cohorts of customers coming back for more, and kind of over time you're seeing the curves go in the right direction? Are you seeing that evidence stack up to give you even more confidence in that, on a bottom-up basis, not just a top-down basis?
So, yes, but not to the extent we would like to see it. I think we are still seeing only a small fraction of the opportunities that come up every month. We use third-party market data to see how many wavelengths are up for bid every month, and we're probably seeing less than 20% of that TAM. We need to see 100% of it.
Mm,
Part of it's building credibility, part of it's demonstrating reliability, consistency, quality. We will see that. And there are a number of constraints on customers that are forcing them not to accept services as quickly as they would like. They may not have the server equipment to plug into, the GPUs are on back order, the data centers don't have the power to provision their services. Each of these exogenous constraints slow down the customer's growth rate and therefore our ability to capture that growth.
yeah, yeah. I've heard a lot about that, 3-month lead times going out to 12 months now for some telecom equipment, and the hyperscalers just soaking up everything under the sun. And it's a problem that others are talking about as well in the longer tail. So I want to go to, just quickly on the technical capabilities of the network. The favored selling tactic by the other competitors is to call this an old network. It's, can't compete with the new stuff going in the ground today. I've seen the studies that suggest very differently, but what do you think this can go to? What's capable? I know you've talked about 800 down the line, maybe 1.2, but how far can this fiber go in terms of performance? And really just trying to answer the question of, you're competitive now, you have great service and quality and reliability now. Will it be relevant in 5 to 10 years as newer technologies come out?
So the answer to that question is yes, will be more relevant 5 or 10 years from now because of the architecture that we've deployed. So let's disaggregate your question into 4 layers. The first one is a physical one, where the fiber is installed and how it was installed. That's both a plus and a minus. It's an armor, it's deeply buried, highly secured. Those are all pluses. On the negative side, the strand count we have is the strand count we're going to have. It's very hard to add incremental
Mm,
strands. We have anywhere from 24 to 144 fibers. None of it was in use. So let's exhaust the inventory before we
sure.
worry about or we
It's
need
a great
more
problem to have
strength.
if you run out. Yeah. You'll have $1 billion revenue business if you run out.
Right. Second point is the fiber itself conducive to the new technologies? The answer is categorically yes. It is SMF 28. It is optimal for coherent technology, and it's had very few splices, meaning that it has less reflection, less refraction, and the ability to carry the signal greater distances. Third, we can add new technologies. You'd mentioned 800 gig, there'll be 1.6, 2.4 terabits. And I was actually talking to one of our vendors the other day, and they said their ultimate goal is to get to over 20 terabits per wavelength. And that
Wow.
will happen. The original Sprint network, when installed, had async 565 equipment. It meant a repeater was every 10 miles, and it carried a half a gigabit of throughput, and it needed two full racks to do that at each site. Today, the equipment we have can carry on a given pair of fibers up to 160 wavelengths and up to 400 gigs per wavelength. We can generally do that with one bay of equipment or less. That is going to continue to improve, and we will capture those improvements more effectively than the guy who has a mix of network vendors, a mix of locations, and a mix of products on the network. So I think at the physical layer and at the technology layer, we win. Now let's talk at the market layer. We could go to more locations, but the challenge is your return on invested capital greatly diminishes at lower density locations. If we had the demand, we would easily extend the network, but we are not. Let's sell where the demand is today as opposed to going where the demand may develop on the come hypothetically. So we have the best footprint today. And then the fourth layer is how do you convince the customer of that? Rather than use channel, agent, or advertising, we do it the old fashioned brute force way of picking up the phone and talking to customers on an order by order, location by location basis. That has resulted in a much lower cost of revenue acquisition. So, by all four measures, Cogent is better off than our competitors.
Yeah, although, I do wish you did a little bit of advertising. We've talked about this. Uh, Maybe just shifting gears. I know we've gone a while. I just want to make sure we talk about capital allocation. And I've got two questions about capital allocation, um, and balance sheet. The first is, I think there's a pretty wide range of expectations uh, across the people that I talk to for what's possible in this data center and IPv4 portfolio of assets that you sit on that are unused. And I know you don't want to give price per megawatt or anything like that, but is there are there wide ranges you could talk about that you're comfortable talking about in terms of like a C outcome is 100 million of proceeds, an A outcome is $1 billion of proceeds. I don't know, but can you put some boundaries on what you hope to achieve with these processes? And if not, like, how do you navigate a process where it's kind of like bring all the deals, some of them are overlapping with each other, you know, let's go down the waterfall of like what's optimal, which could change, depending on whether one goes through or not, like what we just saw. So, uh, understanding how you navigate that process and that you making sure you actually extract proceeds rather than be kind of completely married to a price you may have in mind. Talking through that would be helpful, I think.
So there is a optimal balance sheet structure. In a private market environment, companies are more heavily levered than they are in the public markets. You had mentioned Zayo earlier. Pro forma for their acquisition for Crown, they will be 9 times levered.
Yeah.
I think that would not be sustainable in the public markets. We are at a leverage rate that's above our comfort zone at 6.6 times levered. So we have categorically committed to investors, both debt and equity, that we are going to reduce net leverage to 4 times before we meaningfully return capital to equity. Secondly, we have a track record of returning almost $2 billion to equity, growing the dividend for 52 consecutive quarters, buying back 23% of our float. We have shunned unprofitable M&A, dilutive M&A, and have been very focused on optimizing both return on capital and the return of capital to shareholders. That will continue to be our strategy. We definitely increased the leverage profile outside of our zone of comfort with the Sprint acquisition, the capital we had to spend, the repurposing of the assets. We've announced a transaction to sell 10 data centers. It is substantially more than the 144 million of the transaction that did not proceed for 2 data centers. Secondly, for IPv4 addresses, we have securitized the revenue stream of 13 million of the 15 million addresses that we've leased out and raised 380 million through a ring-fenced ABS on those addresses. We felt that that was a better way to monetize them than to outright sell them. We need to use all of the tools possible to delever. That means we need to sell non-core assets, but more importantly, we need to grow our recurring revenue and operating leverage. Cogent needs to go from the 21-22% EBITDA margins without the Sprint subsidies, the 31% today, back to the 40+% margins that we had without Sprint subsidies before the acquisition. If we can grow recurring EBITDA, we create much more enterprise value than we do from divesting of non-core assets. We need to do both. We need to do it as quickly as possible because IRR is driven both by total return and the time it takes to get that. You know,
Mhm.
we're 9 quarters into this acquisition. We have grown underlying margins by basically 2,000 basis points. We can't keep that pace up for another 2.5 years. It will slow down, but it will be a more healthy growth in EBITDA as it's coming from top line growth more than it's coming from cost cutting.
Right.
And as we add wavelength revenue, we get both top line growth and high contribution margin. If we look at our margins, we at closing were 47% off, uh, 48% off, 47% on, and 5% non-core. Fast forward 9 quarters, that's improved to 61% on, 39% off, and less than 1% non-core. In the fourth quarter, our growth was 80% on, 20% off.
Mhm.
Cogent will return to low to mid 40s EBITDA margins without subsidies from Sprint. The pacing of that will be at least 200 basis points a year, and we will have 6 to 8% top line growth. Most of that growth will come from on-net services. To accelerate delevering, there will be some asset divestitures, but they are not the reason to own Cogent.
Sure. Last question on the second one on capital allocation. Historically, you've done a combination of buybacks and dividends. I remember the days when you would commit to buying back X amount. All right, well, what was it? You had a capital return guarantee, and then above that, you would maybe you had the dividend, then you'd do it. You had discretion over whether you'd return it via buyback or special dividend each quarter. And I never thought you got any credit for the excess that you did above the regular dividend. But you've kind of been had a take on like the John Malone levered equity story type of thing that he would do, except he did it all through buybacks. You've chosen a lot of levered dividend capital return. When you get below 4 times, what do you think you'll go back to if you start reincorporating capital returns to equity holders?
So if you look at our capital return history, we were constantly levering growth in EBITDA and staying between 3.5 and 4 times while we both grew the dividend. The dividend was treated primarily as a return of capital, and we were supplementing that with buybacks. I think that will be our strategy going forward. So once we get below 4 times net leverage, we will begin to accelerate our return of capital. The mix of dividends, return of capital, and buybacks will be dependent on where the stock is and also the tax efficiency at that point in time. You know, if we could invest the money in the business with a higher ROIC, we would. What differentiates us from other telecom companies is we're totally transparent. We can't. So we need to give you, as a shareholder, your money back. Secondly, I think we have shunned unprofitable or distractive M&A. You could argue that Sprint perhaps was a distraction, but I think it was close enough to our core business. It was sufficiently de-risked by T-Mobile, and the upside was sufficiently large that all of this made sense for Cogent. So I think we have a very long runway ahead of us of top line growth, margin expansion, capital intensity moderation, and accelerated returns of capital. That to me is the recipe of a valuable company.
Now, your employment agreement, I mean, you just kind of re-upped with the board, and I know the proxy came out on Friday, and you have a couple different ways you can earn performance shares, one through EBITDA growth and one through TSR metrics. But what's your thinking on your time commitment to Cogent from here? You've been doing this for a long time. What do you think? What are you thinking?
I am old. I have been doing this for a while, but I am absolutely committed to my stakeholders, equity and debt, to see this through, to create as much value. And, just to remind investors, we raised $500 million in the fall of 99 before the dot-com crash. And it would have been very easy to throw in the towel and go away. And we stuck with it. We did complex, very messy M&A, and we emerged creating a 2.3x return for that private equity. We have seen our stock go up and down on multiple occasions, and right now we have three imperatives that we have to be able to demonstrate: a return to top line growth, a continuation of margin expansion, and a movement of our maturities so there is no debt wall or maturity wall risking the equity in the company. We're committed to that. We're committed to multi-year growth, multi-year margin expansion. Listen, I won't live forever, but I think I've got enough health and drive to get us for a few more years and get investors back to where they need to be.
Well, I mean, you can't you can't hang it up right now. You gotta see this through and actually, go on the revenge tour after all this sprint. You took all the pain from sprint. You might as well get the reward.
That's absolutely correct. I mean, we took on risk and we have to see it through.
Yeah. Well, Dave, thank you so much. This has been wonderful. Great conversation. Learned a lot. Really appreciate it. And thank you. Thank you so much.
Thanks, Aaron. Take care. We'll talk soon. Bye bye.